Short selling, what is it and how does short selling work? Some of the most successful people in the stock market have entered short positions at one point or another in their careers. And that is why I believe possessing a short selling strategy in your stock market arsenal is an important tool in helping you achieve the desired results in the stock market. So in this video, I'll be covering the basics of short selling and how does short selling work. The first thing that we need to know is the three main types of trend in the stock market. The first type of trend is the uptrend, and the second is the downtrend, and the third trend is a consolidation. Let's take a look at what these individual trends mean. We say that prices are on an uptrend when prices move up over time. So on our price chart, if we see prices increasing over a period of time, we say that prices are on an uptrend. And when prices move up over time, we see that prices also make higher lows and higher highs. If these two conditions are in place, the first being prices moving up generally over time, and the second is when prices are making higher lows and higher highs, we say that prices are on an uptrend. That's for an uptrend. So the second trend that we'll take a look at is the downtrend. In a downtrend, prices move down over a period of time. When prices move down over time, we tend to see prices making lower highs and lower lows. So again, if we see prices moving down over a period of time and prices making lower highs and lower lows on our price charts, we say that prices are on a downtrend. And the third and final trend is a consolidation. A consolidation is when prices are moving sideways and when there is no clear direction in price movements. In a consolidation, prices tend to move like that. So you can see that here in prices move sideways and there's no clear direction in where prices are moving towards to. These are the three types of trends that you'll see on your price charts, regardless of whether you're investing or trading in equities or commodities or so on. At any one period of time, prices on our price chart will move in one of these three trends. Okay, so for this example, let's try to identify the different types of trends in this price chart. If you have learned something so far in this video, smash that like button because it will really help the channel grow and allow me to produce more content such as this. Alright, let's get back to the video. We'll begin by taking a look at the left side of the chart. So on this part of the chart over here, what is this trend over here? The trend is a downtrend because prices are generally moving down over a period of time. What about over here? This is a period of consolidation because prices are moving sideways and there is no clear direction in where prices are moving towards to. And then over here, at this large chunk of price movement, this is an uptrend because generally prices are increasing over time and you can see that prices are making higher highs and higher lows. So that is a period of an uptrend. And following that, the next period is a period of consolidation because prices are generally moving sideways and there's no clear direction in prices. And the last part over here on the right side of our chart is a downtrend because prices are generally moving downwards over time. On this price chart over here, can you see how prices are moving in one of these three trends at any one period of time? So on the left side, we have a downtrend, then followed by a consolidation, and then followed by an uptrend, consolidation, and a downtrend. And roughly speaking, prices tend to move in an uptrend 1/3 of the time, move in a downtrend another 1/3 of the time, and also move in a consolidation for 1/3 of the time. If you're a participant in the stock market and you only know how to buy and enter long positions, you would only be able to generate returns in the stock market roughly 1/3 of the time. But if you know what short selling is and you know how to enter short positions, you will be able to generate returns in the stock market roughly 2/3 of the time. Knowing how to go both long and short will allow you to have more opportunities to generate returns in the stock market. In fact, some of the most successful people in the stock market are equally comfortable going long and short in the stock market. One of them is George Soros. George Soros is famously or infamously known as the man who broke the pound. Back on September 16, 1992, also known as Black Wednesday, George Soros, alongside other speculators, shorted the English pound. The English pound declined substantially during that period, and George Soros made a cool $1 billion as a result from shorting the British pound. Another very successful trader who enters long and short positions is Paul Tudor Jones. And during the Black Monday crash of 1987, Paul Tudor Jones made a profit of $100 million shorting the market. And perhaps one of the most legendary figures in the stock market, Jesse Livermore, is equally comfortable going long and going short in the stock market. And one of Livermore's short positions was during the 1929 stock market crash. He shorted the market at that time and made $100 million in profit. And to give you some context, that $100 million back in 1929 is roughly equal to $1.5 billion today. You heard that right, that is billion with a B. So Jesse Livermore made a profit of $1.5 billion in today's money, shorting the 1929 stock market crash. And this is what he said about short selling in the stock market. He said that he have never had a problem in playing either side of the market because it was only logical to him to go long and to also go short. The market goes up a third of the time, down a third, and sideways a third of the time, which we have talked about in the earlier part of this video. He also mentions that it is easy for him to get on the short side of that stock. If he can now make profit as General Motors decline by going short, he would do so with no feeling. So from this quote, you can see that Jesse Livermore is equally comfortable going on the long and going on the short side of the market. All these successful people in the stock market include short selling in their arsenal. And that is why I believe short selling is important for any investor or trader who wants to achieve the desired results he or she wants to get in the stock market. Now that we have discussed the importance of short selling, let's take a look at what is short selling. Short selling is an investment or trading strategy that speculates on the decline of the stock price to generate profits. So it is basically the opposite of buying a stock. When you're buying a stock, you are hoping that the price of a stock increases over time. And if the price of a stock increases over time, you will make money. But short selling is the opposite. In short selling and when you short a stock, you are hoping that the price of a stock declines over time. And if the price of a stock declines over time, you will make money. That is the difference between buying and short selling. And in buying, you make money when the price of a stock increases. And in short selling, you make money when the price of a stock decreases. So over here on this price chart, one investor can make money while the other loses money, even though both of them have positions in this same stock. So how is this possible? This is possible because the person who made money during this period of time shorted the stock, while the person who entered a buy position during this period of time will lose money. And this is because as the price of a stock declines, the person who shorted the stock will make money, while the person who went long on the stock will lose money. So can you see how even though both persons had positions in the same stock at the same time, one can make money while the other can lose money? And that is the difference between a long position and a short position. So how does short selling work? If you are shorting a stock, you are basically borrowing shares from other investors and traders or from the broker themselves. Now that you have successfully borrowed the shares from either other investors and traders or from the broker themselves, when it is time for you to close your positions, you will buy back the shares and return it either to the investors and traders or to the brokers. Think of short selling as borrowing money. But instead of borrowing money, you are borrowing shares from someone. When you're borrowing money from someone, you will take a loan from them. So the person will loan you their money or their capital. And when it is time for you to return the money, you will return the principal amount plus some interest. And short selling works the same way. But instead of borrowing money, now you are borrowing shares. So that is how short selling works. To profit from short selling, you want the price of the stock that you are buying at to be lower than the price of the stock that you first borrowed at. In other words, the final stock price to be lower than the initial stock price. And you'll make a loss on short selling if the final stock price is higher than the initial stock price. This picture captures the essence of what short selling is. When you're buying or entering a long position, you want to buy low and sell high, which is the opposite for short selling. In short selling, you want to sell high and buy low. And the difference between this amount is the profits that you generate by short selling a stock. And that in a nutshell is short selling. If you have learned something from this video, remember to subscribe to my channel because each week I release one new video about investing, trading, and the stock market. I'll see you in those other videos to your financial success.